you know,
sorry guys.
Great to hear. What I mean by that is, going to lawyers or law firms who aren't, specifically focused on early stage businesses. It doesn't work. It causes a mismatch of business models, as we point out here. And what you get is a kind of, poor service, a lack of market knowledge, and an all-around kind of bad feeling. Another thing that we hear, our clients consistently give about is uncertainty on costs. So you don't know how much you're going to spend when you go talk to a lawyer. We deal with that by giving fixed fees for the work we do. We agree a price up front and get it done within that price. And the other problem that we see over and over again is kind of a short-term transactional view when either going for legal advice or elsewhere. And it's like, if you're running a business, you want advice, and not advice specifically for a product that's being sold to you at that time. It is, you want a trusted advisor who's alongside you in the business, there for the long run, and understands the journey, understands what it's like to start a business, understands what it's like to go from, on your own right through to scaling upwards. So, we've done it ourselves. We advise hundreds of clients as well at the same time. So that's a bit more about us. We'd like to work with you. Moving on then. And who we are, so we're a team of ex-city lawyers. Effectively what we've done is taken the talent out of a large law firm, ripped out the cost base in terms of overheads, and passed that value on to our clients. So with that, again, we bring certainty on costs, and it allows us to actually do work with early stage businesses profitably, so we can take a long-term view on our relationships. So we're really focused on that. What we help with is funding rounds, obviously what we're going to talk about tonight. So we get money into your pocket, either that be in funding rounds or in exits at the end of the journey. We can help with your commercials, so commercial contracts, terms and conditions, SaaS agreements, etc. And then also, once you're raising, typically the biggest expense is your hiring. At that time, we can help with employment contracts, policies, EMI schemes, etc. Again, with that strategic approach on. So, and ultimately, this is what you get: legal happiness. And we didn't find that as expert execution. You've got someone in your corner that's batting for you. You've got certainty on costs, and you've got peace of mind. When you're running a business, I know what it's like. You've got a million things going through your head. The last thing you want to be thinking about is, oh, was that contract actually a bomb that we've just stuck into the business that's going to blow up at any time in the future? Doesn't happen with us. You get peace of mind. You can sleep easy knowing that we're taking care of you guys. So please do reach out. Sales pitch over. From here on in, it's all value, I promise. So term sheet negotiation. This is the crucial point. Really, you've gone through the fundraising process. You spoke with investors. You defined your pitch, and finally you've got a potential check on the table. This is a real crucial point for companies. You're taking on investors and shareholders into your business who are ultimately very difficult to get rid of. You need to understand the economics of the deal, how this is going to impact your business going forward. And it's an incredibly important point, and one I can't stress enough to invest time in, educate yourself on, and really get an understanding of both sides of the table. If you've got a good advisor next to you, they should be explaining to you, okay, this is what the investors are thinking, this is what the company is thinking, this is what you should be pushing for, and also this is what's market. So to be able to rely on advisors in that way is something that is crucial, and it does come with relying on that stage specific advisors, as I mentioned. Not just lawyers, your board, accountants, tax advisors. Just make sure that they're very stage specific in their approach. They understand where your business is, where you want to get to, and what are the hurdles in front of you that will ultimately get you there. I always say negotiating a term sheet is probably the best value you're going to get out of lawyers. It really is. It's effectively it's a non-legally binding document, but it's a commercial summary of the main commercial points negotiated between the principals in the business, between the investors and the company. And so this is really where the meat of the negotiation of a funding round is thrashed out. So it's really important to get it right. As I said, understand both points and be well advised around it. So today this is the structure of a typical term sheet. Again, today we're going to concentrate on the kind of seed through Series A. space. So, you know, you typically have institutional investors coming on board at that stage, and you'll have the kind of additional protections that you may not have seen that investors request at the earlier stage. So if you're just kind of doing that like first initial pre-seed round, you know, typically it's at your kind of seed and series A that these more complicated terms come in as you've got institutional investors come in. So the lens to look through any term sheet, the way we approach them is, you know, through three lenses and kind of three approaches. Is, you know, one, what is the economic terms of the deal within the term sheet? What are the control terms within the deal? You know, what are the control mechanisms that the investors are going to place on the business post round? And then also, what are the administrative terms? Administrative terms, things at the end, don't get too caught up with them, don't be distracted by it. If you want to read more in detail generally and kind of educate yourself around kind of VC investment, Venture Deals by Brad Feld is just, you know, the book in this space. I normally keep a copy of it on my desk. It's an excellent read if you're, you know, raising now or will be raising at any time in the future. Can recommend it strongly enough to go back. They update it every couple of years as well with things like, you know, crowdfunding into the market, etc. So pick up the latest copy, have a read of it. Really, really worthwhile. And actually, this lens is actually from them, for full disclosure. But it's a really good way to approach things. So we'll be going through each of these elements now subsequently. And like I said, pop up with any questions. So it's always good to get some feedback. So the first section, economic.
Sorry, Bill. Just a quick question. So a couple of the guys are missing. What was the book called? And can we?
Venture Deals by Brad.
Okay. Thanks, Rav. Thanks, someone's put it in there. Harsh, could you find a link to the book and drop it in?
Yeah.
Okay, maybe you should buy a few copies and resell them. There's a margin there.
I should actually, yeah. And I usually have it as a prop as well if I want it, but it's excellent. Can't recommend it strongly enough. I actually read it in a day because I was kind of geeking out on it, just because it's so relevant and so interesting. So, you know, again, get in there, read it, but this workshop will give you a really good overview of it if you just want the cheat notes as well. So the economic terms of the deal, you know, the way to be thinking about this is how's the money coming in? You know, how's the money ultimately going to leave the business, both you know, through the initial investment and subsequently at exit, really. So how does money get into the business? You know, typically it's two ways. It's either debt or equity. Here we're going to concentrate on equity, and, you know, predominantly in the UK early stage market, it is equity investments for the most part. And so as a result of an equity investment, you're going to be issuing shares. Typically either two types, either ordinary or preferred shares. Ordinary shares are the shares that you will have incorporated if you're a UK company first day. So they have equal rights in terms of voting, dividends, and rights to participate in the winding up or capital. So that's typically where founders will sit, and also early stage angel investors who are claiming SEIS and EIS investment relief. SEIS and EIS relief, I'm not going to go into too much detail there. You know, needless to say, it's, you know, one VC actually referred to it as the most innovative thing to come out of the UK in the last 25 years. Technology aside, the tax breaks for early stage investment is probably the reason that we're all here today. So if your business, if you're not aware of SEIS or EIS, get on it, you know, get registered for it, particularly if you're raising from angels or from EIS or SEIS funds as well. So it's a huge thing. I'm not going to spend too much time on it, and we don't give tax advice, but needless to say, get involved in it if you are doing that first round. So that'll be ordinary shares. Preferred shares are shares with enhanced voting rights. So that would be, shares with enhanced rights, typically requested by investors. The main reason that investors are looking for these enhanced rights are around downside protection and investor protections. So they would be things like anti-dilution and liquidation preferences. They're, you know, the real two probably main levers that institutional investors will use to try to protect their downside, and that's really protecting against very high valuations that subsequently don't come to fruition post investment. We'll come on to both mechanics a bit later. So that's the difference between ordinary and preferred shares. On SEIS and EIS, investors can only claim the relief on ordinary shares, so they can't have the additional investor protections. The rationale there being that investors are already getting a fantastic tax break. They need to put their capital at risk in order to gain the tax relief. So those investor protections are wiped out, which is great for the companies and also great for lawyers, keeps things nice and simple. And you can execute on rounds really quickly, which was the original rationale. So so that's the different types of shares, ordinary and preferred. So preferreds, typically when your first institution comes on board, is the way to remember that. Convertible loan notes. So this will be a debt instrument, and effectively it does exactly what it says on the tin. It's a loan with a coupon that converts at a later date. These originally came out of Silicon Valley as a result of too high legal fees, and it was developed as a quick way of getting money into a business without kind of going through the rigmarole of negotiating long-form documents and also having conversations around valuation. So you can kick that conversation down the road to a conversion point, which is typically either a funding round, an exit, or a long stop date at some point in the future. So convertible loan notes, not as commonly seen, particularly at the early stage, because most early stage angels are trying to claim SEIS and EIS again. But you see it more and more now that there's been a large influx of non-UK capital over the last couple of years. We're seeing more and more US VC cash come across. So more CLN notes are turning up. So non-UK investors may look for them. Typically, UK investors will either go with equity or an advanced subscription agreement. So an advanced subscription agreement, again, really quick and easy way of getting cash into the business. Very simple agreement saying that, hey, me as an investor are going to give you cash. The company, you are going to issue me shares at a later date. We can kick down the road, conversations around valuation, around the long form documents, as we said, and it's just a really quick and easy way of getting money in. So if you need a quick top up before a round, these are great ways of doing it. And again, it's SEIS and EIS compatible at the point then where the advanced subscription agreements will convert or the shares are issued at a later date. So there are two ways to think about that. So valuation will be the next big point on any term sheet. It's one that's kicked around between founders. There's no bright line rule. The factors in evaluation that investors and companies will argue about were typically, what is the stage of the company, who are the team, is this seasoned entrepreneurs that are coming around again, or is this someone fresh out of college, first-time founder? What are the numbers in the business, be that either revenue or traction, and what's the economic climate? In terms of, is there a lot of competition with other funding sources to get into a particular cap table, rising valuations? In terms of the economic climate generally, 2020, pandemic aside, turned out to be a record year for UK tech investment, both in terms of money going into companies, but also funds being launched and capital being raised for funds in the UK. So, the back end of last year was extremely busy, both from, companies raising money, but also funds. So, the general consensus is, and the general knowledge is, there's a lot of funding floating around right now. There's a lot of cash sloshing around. The printing presses are whirring away globally, and a lot of that money is being squirreled into venture capital and technology investing, given its performance during the pandemic. So, I'd say if you're a UK or London-based, particularly, or generally, technology company, there's never been a better time in history really to raise venture capital, and particularly in Europe. The UK dwarfs the rest of Europe in terms of investment amounts, funds, and cash being deployed, etc. So, in terms of, will that see a rise in valuations? You would expect so. But that's it's being borne out in the data, which we'll probably see Q2 data coming out pretty shortly. One way of benchmarking that as well in terms of valuations is quite easy to looking up Bohurst, pitch deck. There's so much data out there now in terms of what like for like companies are raising at and what valuations are raising at. 5-6 years ago that data wasn't available. Now you've got Dealroom, Bohurst, TechCrunch, etc. So you know, get out there, benchmark, and really have that that argument ready. So the purchase price would be the next thing in the term sheet, i.e. what is the share price? The share price would be the pre-money valuation divided by the fully diluted share capital of the company. Now, fully diluted means all the shares in the company plus anything that could possibly convert into shares, assuming they have converted. So that brings to mind, you know, the ASAs that we spoke about, the CLNs that we mentioned, anything that could be convertible into equity is converted, and then the share price is calculated on that basis. And that, you know, that has impacts in terms of pre-money valuations and things to be aware of, which we'll come on to on the option pool on the next slide. A quick word on post-money valuation, very quick, very easy to calculate. You take your pre-money valuation, you add the amount you've invested, that gives you your post-money valuation. If you want to calculate how much dilution you're going to take the cash that you're raising over the post-money valuation. You know, we see that done incorrectly quite a lot. Definitely worth being accurate with that, and you know, having those cap tables, models, and scenarios mapped out is, you know, incredibly important. One element that we see now and again on term sheets with institutions would be staggered financing. So staggered financing is saying an investor coming and saying, look, we're going to put 3 million into the business, but we'll give you 1 million now, 1 million in 6 months, and 1 million in 12 months, subject to some KPIs. From an investor perspective, this is great. You know, you're not cash out, you're hedging your bets here, and you know, you are keeping some in reserve in case the management team or the business doesn't fly as expected. From the company's perspective, this is not as great. You know, you don't have the full war chest to go after. You've also got these predetermined milestones to hit. And then what's crucial here is really defining those milestones very, very clearly. They need to be eminently achievable. You know, you need to be able to do these with your eyes closed. They need to be crystal clear in terms of once they're achieved, what is the drawdown mechanism and how do you actually get your hands on the cash? There can be any delay there. And you know, it's ideally it's just something to avoid, full stop. You know, that would be, you know, my recommendation. If you can get rid of it, just get rid of it. Because you can see teams end up in very tricky situations if those milestones aren't achieved. Because ultimately what happens there is, you know, the founding team are heads down trying to hit these milestones, getting closer and closer, saying, yeah, we might hit it, and then they get to the milestone, they're like, we missed it, which then leads to very awkward conversations with your investors. You know, hopefully the investors continue to believe in you and say, great, you know, we'll fund anyway. If they're not, if the kind of confidence is shaken, or they, you know, take advantage of the situation as is their right, they can say, well, look, you know, let's talk about the valuation. You know, we could do a down round, we want more equity, or we just won't invest. You know, full stop, we've got cold feet, there's no longer investment. From the founding team's perspective, that's very difficult because obviously you need to go to market to raise more money with this kind of bad news story and cloud hanging over you. So it's a very difficult process. You know, we've seen teams do it, but again, you know, you need to be really, really careful that those milestones are eminently achievable. So in terms of the ESOP and the interaction with pre-money valuation, you know, the ESOP is something that at times I think particularly kind of first-time founders don't pay too much attention to it. It's like, yeah, 10% is absolutely fine. You know, we'll take that dilution. What's actually happened there is, you know, your pre-money valuation has just been dropped, has been reduced by 10%. So you just need to be very careful of how big this option pool is when it's coming in. And the reasons for it, like, you know, if you don't have a need for a huge option pool, then, or, you know, a big option pool, push back and just say, look, you know, we don't need it right now. Here's our hiring plan from now until the end of the runway that we're raising. You know, we're making 2 hires, so we need a maximum 5% option pool or 10%, or, you know, whatever that number is. So, you know, try to share that dilution ideally. Can't always achieve it, but, you know, some investors will adhere to that, or, you know, agree to that. And, you know, another question as well becomes, like, where does that option pool come from? Is that always the founder's equity? Is it, you know, previous investors' equity from previous rounds? Those conversations are ongoing. We had one team come to us a few weeks back and they were like, hey, you know, we've been talking to a few platforms, we've been talking to our accountants, we just need to get an EMI scheme. You know, what are your fees like compared to XYZ? I was like, yeah, cool, let's talk about it. Tell me the advice that you're getting from the platforms and from your accountants. And they're like, oh, well, the 10% equity needs to come out of my pool. So I'm giving up 10% of equity right now, and we're putting in place the option pool. You know, right there and then we were like, look, you're giving up 10% unnecessarily here. What if those options are never exercised? You know, there's much more founder-friendly ways of doing that you can retain your equity until such time as the option pools until the options are needed. So, you know, from some fairly dicey advice that they got elsewhere, we were able to like turn that around for them, which is great. And you know, giving someone back 10% of their company is a great feeling at the end of the day, and they're a very, very happy client, needless to say. So again, just be aware of that, you know, option pools, anything to do with dilution, really examine it, get into the detail and understand the impacts that it's going to have, not only on this round, but on subsequent rounds as well. You know, that's what
quick question for you, Bill. So what would you say is the norm? Is there a standard for where this comes from? Should it, you know, what do we typically see? Or?
Yeah, it's crept down over the years, I would say. You know, like there was kind of 10 to 20% was kind of, you know, marshaled about quite a lot. I would say kind of anything above 10%, we'd be kind of raising an eyebrow on, and, you know, we'd actually be trying to, you know, not force it down unnecessarily, but just take a look at, you know, where is this option pool going? Like who's actually going to be awarded?
So what is the standard of where it comes from? Like, you know, obviously if you're saying it's not coming from the founders, is it issued by the company or? Yeah,
it would be the previous round the current shareholders at the point of an investment round. So, you know, obviously the first investment round, that is the founders. And then subsequent rounds, typically incoming investors will say, you know, we're not coming in until you put in place or top up the pool to a sufficient level. And, you know, like where we kind of start pushing, well, you know, there's something to be mindful of is obviously as you go further and further, you know, your option pool does not need to be 10%. If you're valued at 50 million, you're not unlikely going to be giving away 5 million of equity in like very short order. So, you know, the option pool percentages shrink as time goes on. And it's, you know, just something to be reviewed at each point. But, you know, we have seen teams that split the option pool. So they'll just say, yeah, we'll take half the dilution, you know, we'll put the other half of the dilution in post round, and we split the difference. So yeah, it's a bit more of an equitable way of doing it. And yeah, that's typically the way it shakes out. But yeah, in the early stage rounds, it'll always be current shareholders get the dilution. You know, incoming investors will just say, yeah, that's the way it's done. So that's the option pool. So liquidation preference, you know, this is one of the investor protections and an economic term that you need to be paying attention to. Liquidation preference, anytime you see it, you immediately think who's getting their money out first. You know, it's think about who's got first slice of the pie at the point of exit or at the point of liquidation if the company is wound up. And the rationale here is that investors will say, look, we've actually put hard-earned cash in here as opposed to equity or sweat equity. So we should have a priority in terms of getting that cash out in the event the business is sold or like I said, liquidated. There's two ways of doing this. You can either participate with a liquidation preference or you can be non-participating in a liquidation preference. Participating, think of it as taking two bites, right? If I'm participating at the point of liquidation or sale, I'm taking my initial investment out and then I'm taking my percentage entitlement as a shareholder. So if I'm a 20% shareholder, I'll take my initial investment plus 20%. That obviously has a big impact when there's a smaller pot. When you get to much bigger pots and bigger exits, this becomes a bit less of an issue. But, you know, at a very early level, you know, we see that the worked example here that, you know, with a 1x participating liquidation preference and a 20% cut in a 5 million exit, instead of, you know, the 1 million that you'd get if this wasn't here, you'd actually get 1.8 million as an investor. Again, it's very, very important just to get your head around it, understand it, and just make sure to know what is and what's not market. A non-participating liquidation preference is more the market standard. You know, if you see anything other than a 1x non-participating liquidation preference, it raises a flag, quite frankly. Either the investor is kind of, you know, doesn't know what market is pushing you in terms of not knowing what market is, or is, you know, just generally maybe quite aggressive in their terms. You know, these are all things. We actually had this with a founding team the start of last year. You know, the investor, VC, approached them, came to us, said, look, we've got a great term sheet here. We looked through it and we're like, actually, that liquidation preference is, you know, off market from what we're seeing. Then we, you know, verified it ourselves by ringing around our own network of founders and, you know, other clients that we've talked to, and like it was universally agreed that, look, this is off. So the team in question actually walked away from the term sheet. They were like, look, no, it's not one for us. Fortunately, they were in a strong team, and we're able to, you know, go and raise a really good round with some investors that they're absolutely delighted with now. But yeah, it's again, make sure what is market, understanding that is, and, you know, checking with your peers and your advisors is really crucial. So the non-participating, you effectively take either or. So you either take, as an investor, you take your money out, or you take your percentage entitlement. So you only get, you know, one bite at the cherry there. So that's liquidation preferences. Again, doesn't happen at the very early stages because of SEIS or EIS. Later stages, from, you know, seed, series on, as soon as you got an institution involved, you're more than likely going to be negotiating these. Anti-dilution then, again, another investor protection that you'd see more on the institutional side. So this gives down round protection. So in the event that you have a great valuation, you've nailed the round, all of a sudden something happens and you're raising at a lower valuation, this is a protection for investors. And, you know, the rationale there being, you sold us something at a high price, it's now at a low price, we want some money back. Again, you know, perfectly reasonable rationale. But, you know, the way you go about it can be either kind of more aggressive or less aggressive from an investor perspective. The two ways you do that is either by a full ratchet or a weighted average. Full ratchet just means that you effectively reprice your previous round to the new down round's valuation. So you can imagine the dilution that you're going to take from the founding team and the rest of the cap table takes when that happens. So you're already raising at a lower valuation, so you've got money coming in to dilute you, but then you're repricing the whole previous round on that as well. Well, for all the shareholders that have this protection, so you're taking a, you know, a double whammy here, and, you know, oftentimes this can just be catastrophic on the cap table. So again, if you're seeing full ratchets, be very mindful. It's probably a bit of a flag from an investor perspective, but, you know, at the same time, hopefully you've got the choice to walk away. A weighted average is a bit more balanced approach, and, you know, like I said, it's probably more the market standard in the UK. And effectively what that looks at is what's the share price between the two rounds and how much is being raised in the down round. So, you know, if you're only raising a small bit and there's only a small bit of price difference in the share price, then, you know, the previous investors only get a small bit of dilution. The rest of the cap table is kind of protected, and the company can drive on, as opposed to that full ratchet. One, you know, counter to the ratchet, and, you know, most investor protections in general as well, is the pay to play. So effectively what a pay to play says is, look, you know, we'll give you anti-dilution, we'll give you a liquidation preference, but in order to keep those protections, you need to keep investing, you need to keep supporting the business. So that would be effectively saying, look, you know, happy to give the protections, but you keep backing us, because, you know, if we need to go out and do a down round and our current investors aren't backing us, you know, that could be catastrophic or existential to the business. So, you know, come play with us. So that is anti-dilution and liquidation preferences. And the shares, they're the kind of main economics of any deal. The control provisions of the deal then are things to be aware of that, you know, you're going to operationally and for future rounds need to be aware of. So pre-emption rights is the ability for your, you know, current investors and current shareholders to participate in subsequent rounds. And effectively this says, look, if you're either issuing or selling shares, current investors should get a pro rata entitlement. One thing to be aware of there in terms of pro rata, just make sure that everything above the pro rata entitlement goes back to the board's discretion, because it's a kind of a backdoor control as to future rounds for investors. So it's just something to be aware of. Again, it should be pro rata, and then any additional issuance or transfers go back to board discretion would be fairly typical. So tag and drag along. So a drag along is the ability to drag, as you might imagine, a minority of shareholders in the event of a sale. So, this is born out of, companies not wanting to be held hostage by a small minority. So, if an acquirer comes knocking, then you should be able to, at all times, tell them that you can actually get a sale through your shareholder base. Any potential acquirers typically will want to buy 100% of the company. So this is a very crucial term. Who becomes part of that dragging majority changes over time. Initially, investors will always want to be part of the dragging majority. From a founding team's perspective, if you want to retain some control, what you can, position is that, fine, the investors can be part of the dragging majority up to a certain valuation, at which point that veto falls away. And the rationale here is that, look, if we're all driving towards an exit and we achieve that valuation, that exit, then we as a founding team want to retain control over that exit process. And once the number is kind of sufficiently large, most investors will get on board with that, because again, incentives are aligned on both sides of the table. You can drive, and it gives management a huge incentive to do so. Conversely, as the rounds go forward and you and founding teams get diluted more and more, you want to make sure that you're part of that that dragging majority, so that the company can't be sold from under you. If that is the intention, if you're still with the business at that point, I want to retain control. Make sure and look at those drag majorities and make sure to be counted within that majority, because that effectively gives you a veto over any exits down the road. So tag along then is the inverse protection. So that would be for a minority of shareholders, that if a share sale, or say if the founders are coming along and saying, look, we're going to sell out here 52% of the company, we've got a willing buyer, they're happy to take it on, and good luck and good night. What this tag along right is allows any minority shareholder to actually tag along and participate in that deal, effectively not be left behind on that, on any exit. Perfectly reasonable, generally very uncontroversial. But good provisions to understand and walk through. Founder vesting, another control mechanism in terms of incentivizing people to stay within the business. It's renegotiated, I would say, at every round. From vesting is effectively, I guess, with every round, the management team are effectively promising that they're going to execute on a business plan and take on capital to execute on that. So the natural question becomes for investors is, what happens if you were to leave? From a founder perspective, there's risk here in terms of losing your equity. So again, it's something to be very mindful of. Generally the arguments go back and forth is, what is the vesting period? 3 to 4 years would be, fairly typical. With a 1-year cliff early on, I would say, as rounds go forward, most people won't accept a cliff. And really, as the round goes on, the time that's been spent in the business, most people want that time recognized. So that can be done by either shortening the vesting period to say 2 years, taking equity off the table, i.e., saying, okay, well, look, we're only putting up 50% or 25% of equity at this round to recognize the work that's been done to date. And as the business grows and is in a stronger position, obviously the management team and the founding team have more negotiating powers in this negotiation. The rationale for clawing back that equity would be that the equity needs to be redistributed to whoever's coming in to the business, which stacks up. And oftentimes, if founders are leaving, the request would be that their shares would be converted into non-voting shares. I saw quite a prominent VC put this up as a founder protection, which isn't recently. They said, look, vesting is a founder team protection. It's not just investors that benefit. Obviously, in a co-founding team, if one were to leave, you know, you need to be mindful of that. We see it a lot, obviously, and you know, these vesting provisions are there also to protect you as a co-founder in order to get back that equity. So, you know, look at the provisions, make sure that the equity at the point of an exit goes to the right parties. I.e., if we're saying this is a founder protection, then the equity that should be clawed back should go to the founding team. You know, if it's a situation where that equity is going to be incentivized to bring someone else in, then that equity should obviously go to either an option pool or to an incoming CEO or founder replacement. But, you know, again, walk through the terms, walk through the rationale, make sure you're comfortable with it, and that ultimately commercially it stacks up. You know, good bad lever provisions are you know, one of the most negotiated points, I would say, and one of the areas that there just is a lot of not arguments about, but just different approaches and different rationales, and we see it across different teams. Different teams take totally different approaches to how they deal with this. So, you know, it really is a conversation amongst the founding team, the investors, and understanding, you know, what makes sense for the business as well. So that's founder vesting. So veto rights or reserve matters. You know, these will be a list of matters that effectively can be taken without either an investor majority consent, i.e. a majority of the investors on the cap table, or an investor director consent, or, you know, both in a lot of instances. So what they will be there's a fairly standard set of actions, and, you know, they can probably be boiled down into, you know, things that the management team could do to run the business into the ground or screw over investors. You know, in this instance, you're probably, if you've got an investor that's, you know, very hot on this, then they've probably been burned by, you know, another investment, or, you know, seeing it happen elsewhere. The main thing to look through this is, you know, when you're looking at these actions is, you know, can I run my business? Can I raise more money? And can I exit? They're the kind of three things that I always kind of look through these lists on, is like, you know, all right, can the management team be running the business day to day? Is this overly controlling? Two, if continual raising is the game plan, then there can be no blockages within the investor vetoes over raising further funding, because ultimately that could be existential to the business. So you want to knock all those out. And, you know, can you exit the business? You know, as we said earlier on, with the drag along rights, etc. It can be above certain valuation hurdles, but you do want to those elements.
What's up, Jessica?
I'm going to try to mute. There we go. So yeah, look, a set of predefined actions that will require that, you know, investors have a veto over. A veto, it's important to differentiate between a veto and a positive action, or, you know, an obligation that the investors can place on a business. They're very rare. You know, typically it is vetoes that the investors will have over the business, rather than be able to take unilateral actions. The board and how that is set up will, you know, be a key negotiation in the term sheet, and will be detailed in there. How is this normally set up? What we warn against is, and, you know, with all these investor protections on each round, is that, you know, these rights tend to stack on top of each other as the rounds go on. So it's important to, one, get a good base level in your first round, but also, you know, just be pushing back on it and making sure that this isn't becoming obstructive to the business as the rounds progress as well. So, you know, most lead investors will want to take a board seat. What you typically try to do is link that to the current shareholding at completion, i.e. if on the next round that investor wasn't to participate or didn't lead the next round, then their board seat would fall away. Would be, you know, very, very typical. And, you know, I think it's an important point, given that, you know, you may have taken on an investor as part of your angel round. You know, you might take on as kind of a seed or pre-seed. You know, by the time you get to Series A, all of a sudden you could be 3-2 with a co-founding team and outnumbered at board level. Not something you want. You always want to retain control across the board. So, you know, it's important to push back on that and, you know, retain control as much as possible. And you know, the same investor, the same director that's going to be able to give you advice at the very early stage is unlikely to going to be able to give you advice right through to scaling and exiting. So, you know, you may have a superstar in there, or you may have a kind of a hobbyist angel investor director. Bear in mind, again, coming back to that kind of stage-specific advice, make sure you're getting the right advice at the right time for your specific situation. So that'll be the board seats and how that's typically set up. Again, founding team will want to retain control as much as possible. Observers are people in the room. You know, they can't vote. They're not a director, but you know, I'd be mindful of it. Ultimately, there is someone in the room that can influence decisions, that can influence thinking, etc. Make sure that they're bringing value and they're relevant to the business. And we kind of talked already about, you know, these appointment rights should always be linked to minimum shareholding percentages. It's really important as you progress. So employee share option plans, ESOPs, EMI schemes is the most tax efficient way of doing this in the UK. We do them ourselves. They're a fantastic way to incentivize employees when done the right way. Done the right way, I would say, you know, making sure that one, the size of the pool is appropriate. Two, you're incentivizing the right talent within the business. You know, someone, again, coming back to that stage specific, someone who's very impactful at an early stage may not be as time goes on. So just, you know, be mindful of giving away a lot of equity at the start. You know, we constantly see and talk to teams that really regret doing so. So, you know, just be aware of the journey and understand, you know, what it's going to be from here to exit, and be mindful of that. As you said, you know, over the last, during the pandemic, when, you know, people weren't giving wage increases, we did see a lot of EMI schemes come into play and people being rewarded with equity, which is, you know, it's a great way of incentivizing talent, as I said, and aligning everyone. You know, the things to consider there are what are the vesting that we talked about there, and what happens if someone were to leave. Again, teams take different approaches here, but, you know, generally you tend to kind of want to claw back that equity, whether it be vested or not. But, you know, again, we can kind of chat through the options there. What we see as well is, you know, we strongly recommend exit only options. You know, ultimately, UK early stage market doesn't have a great deal of liquidity. You know, platforms like Cedars are trying to bring that into the market, which is great. But ultimately, you know, the shares in early stage businesses really crystallize and the returns crystallize at the point of exit. So having equity before that, you know, doesn't really make sense. And the last thing you want is, you know, 15 employees on your cap table kind of running around trying to get their shareholder, get their signatures on shareholder agreements, etc. Keep it exit only options as much as possible. And we talked already about the pool size as well. That's great. So the administrative terms of the deal, and those are nearly done. So these are the terms, as we said, you know, they're not to be dismissed, but at the same time not to be distracted on. You know, the meat of the negotiation is around the economic terms of the control terms, and, you know, how they'll interact, and, you know, the impact that they'll have on your business. So the information rights are the, you know, the reporting functions effectively that teams will need to do for investors. On these, you know, quarterly at the very early stage, monthly as things progress, it's very typical. What I would say about the monthlies is just make sure that, you know, you can hit a button on Xero or whatever your accounting software is, and those reports can be produced very simply. Or, you know, whatever your operations are that you're reporting on, just make sure that this doesn't become a monthly drag on resource, on time, and something that you end up dreading doing and taking away from actually growing the business rather than reporting on it. So just be mindful. The use of proceeds within the term sheet, you know, you'll be asked to produce a business plan and give a business plan. Ultimately, stick to that business plan. Some of the reserve matters will relate to the budget and the business plan, so, you know, be aware of that when producing it. You will typically need to put in place insurance. That's typically key man and directors and officers insurance, particularly if an investor director is coming onto the board. You know, something to think about, but, you know, very easy to get your hands on these days. The founding team will also need to either enter into employment contracts at an early stage or have their contracts reviewed, typically as the kind of rounds progresses. And, you know, that'll be looking at salary, non-competes, holidays, etc. So, again, that we looked at. The most important thing that comes through in DD, and it's always just crucial, is that your employment and contractor agreements have IP assignment clauses in it. Just can't stress it enough. Just to have in place, really tight IP assignment clauses in. It's something that investors look for, and best avoid scrambling around and looking for them. Last thing are warranties. So warranties are statements that you'll make and the company will make about itself, about the company, its operations, and which, if proven incorrect or false, and damages are shown by the investors as a result, can result in liability both for the company and for founders personally. So not something to be taken lightly, something to be reviewed, tightly drafted, and disclosed against. So if you're reading through a set of warranties and something niggles, disclose against it. Overload information. Make sure that ultimately your defense is that any investor was in full awareness of any situation, be it around the warranties or any breaches, etc., at the time of investment. So and ultimately that's what investors want to be in, is have full knowledge of what they're investing in. So again, you're probably you might be hiding a few skeletons as you're going through the pitching process, etc. That the disclosure letter is the time to get them out, and disclose them as much as possible. And they'll be on the cap table, business plan, material contracts, IP, property, etc. There'll be a big list of them. They actually take a lot longer every time than anyone actually wants to, but unfortunately they're necessarily legal that investors aren't giving up on anytime soon. So that is everything, guys. That's a whistle-stop tour of term sheet negotiation. As I said, as Bill Cogan from 7 Legal, we'd be delighted to help you through funding rounds. We're constantly doing them. We enjoy them, and yeah, love working with founders. So please do reach out. I think Mike's going to tell you about a free 30-minute consultation with us. We'll also happily look at any term sheets without charge. So yeah, when you get them, shoot them over, and look forward to speaking with everyone. And yeah, guys,
great stuff.
Some questions and me stop talking.
Brilliant. That you're stopping talking. No, I'm joking. No, that was some great advice and really practical. So so great stuff. And as Bill mentioned, he does offer free consultation. And I think it's a superbly useful thing. We've had some great feedback from the guys who have taken up on this. Just if you want to pick his brains, if you have some initial thoughts, either around term sheets or your negotiating position, feel free to reach out directly to Bill. His details we've dropped into the chat, or reach out to him on LinkedIn, or give us a nudge, and we can put you in touch with him. Yeah.
And actually, Mike, just one thing there, the best time to do that is before signing the term sheet. It goes without saying, but honestly, we do see it quite often that, we're given a term sheet and it's like, this is great. And, we're really excited about the term sheet, and you hand it over and, it's not great. And it's very difficult to roll back from those positions. It just leads to, quite entrenched positions from investors, etc. So come talk to us early. Happy to have a chat.
Thank you. Great stuff. Now, there's a few questions that we didn't manage to get through previously. So we're going to go back through, and I'm going to ask some people to unmute themselves and to ask the questions direct, so we can hear from a few founders as well. Okay, let's see. So we had some questions first from Mark Weston. Mark, are you still there? Do you want to ask Bill your question about safe paperwork or ESAs convertibles?
Yes, just coming off mute. Can you hear me?
Yeah, absolutely.
Yeah, hey. So one of our advisors said for early stage investments where valuation is harder, pre-revenue, product not quite finished, product market fit not quite there, to look at the safe paperwork. So came out of Y Combinator. I think other people's are using it as well now. So you can kind of kick the can down the road on the valuation. I'm just wondering what your view on that is, and whether you're seeing that happen in the UK.
Yeah, we're seeing kind of safes. We're seeing an influx of US cash come in. We've seen we've seen a mixture. We've seen safe notes come across. They do need to be adjusted for the UK. I don't know if you read them, but they talked about preferred stock, etc. So they do need to be made more UK friendly. But it's not very difficult to do. The advanced subscription agreements are actually a simpler agreement and much more straightforward. They're kind of I'd recommend them over safes, to be honest. In terms of from a founding perspective, if you can kick the can down the road in terms of valuation, fantastic. It's definitely at your advantage if you can't get a great valuation now, but you're saying, look, it's very difficult to price this. Let's kick it down the road until we get a price round. Go for it. Fill your boots. I think from an investor perspective, they'd probably say, all right, look, we're happy to leave it run a little bit, but it will be subject to certain caps. I.e., if you go and raise it 25 million, we still want to be recognized about the risk that we're taking right now. So you can it's definitely founder friendly. So fill your boots, 100%.
Thanks, Bill. Appreciate that.
Okay, great stuff. Right. Okay. And we have another question. We have a question from Sean Dawes. Okay, so something that's always seems to creep into pretty much every workshop that we do is a question on crypto. So Sean, are you free to ask your question? Yeah, there we go.
Yeah, can you hear me?
Yeah. Hey, Sean.
Okay. So with a lot of these companies now putting some of their equity into cryptocurrency as an investment, do you see or have you heard of any investors while going into a company stating maybe to put some of that equity into crypto as kind of like an interest yield while it's waiting to be used?
We haven't really seen it at the early stage. I guess typically you'd have reserve the vetoes that we talked about as we were going through. Typically that would be quite a prominent one in that if you're raising money off the back of a business plan, and unless that business plan says, hey, we're going to put 20% of it into crypto, typically you're pretty locked up in terms of what you could do. So if you take on $1 million investments, you're saying, look, I'm building software, that's what I'm going to do. The documents will be set up so that you can't then say, actually, we're not going to build software, we're going to go and invest in crypto. Because ultimately the investors will be investing on you on the basis of being a software developer or a team that's building software. They don't know about your crypto expertise. Similarly, you don't raise investment if you're raising investment into a software company, you're typically not allowed to go and do M&A. Because you may not be an M&A expert, you may not know the market, so you'd normally have to go back to investors and say, look, we've seen this company, we've got some cash, we should go buy it, and typically they'll kind of write off on that. But so in summary, unless you're saying it at the gate, then unlikely. And we're not tax advisors, but I don't think if you're raising money through SEIS or EIS, it's that UK tax break, I don't think you could claim tax relief if the company itself was just trading in crypto. If you can, let me know, and I'll throw a few quid in maybe.
Okay, great stuff. And Bill, the next question is probably one for both sort of me and you, which was people were asking about how did I value my own company and how do you go about a situation where the founder's valuation is different to the advisors. And I guess, maybe I'll throw my 2 cents, having probably negotiated a few valuation rounds. And I think, look, the long and short of it is it's whatever you can convince someone to pay for it is the value, right? So at the end of the day, I've seen founders with terrible companies who are amazing salespeople get valuations of 3-4 million with just a pitch, no revenue, no product. I've also seen I even know one company that got pre-revenue, pre-product, 30 million valuation. So it can really vary, but normally, the extenuating circumstances aside, there are some basic rules, like for instance, in the fintech or the SaaS space, you're normally looking at 10 to 12x the valuation. If you look at exits and multiples and comparables, if you are pre-revenue and you've got SCIS or EIS, you're normally looking at a max 3 million valuation. Most companies are probably in between 1.5 to 2 million pre-revenue. So there are a few rules that once you've sort of, I guess, been around and worked with a few companies that you generally can stick to. In terms of, what do you do if your advisor says it's valued at something else? Well, the long and short of it, it doesn't matter what your advisor say or what you say. At the end of the day, if you're fundraising, it's, can you find someone to pay that? If you can't, then you probably need to lower your price. And I think from my perspective, I would generally recommend to people, it's better to start off low and then put up your price when there's demand than to start up high, because if they reject it when the price is high, you don't get a second chance to go back and go, oh, actually, I've lowered it by $1 million. Because then they go, right, okay, so you were either wrong or your company is doing worse than you thought. So, it's not good that way around. Anyway, that's my tuppence worth, but over to you, Bill.
Yeah, absolutely. I think 100% what someone will pay for something is the price. I think where we've seen, founders run a tight process is where they'll go out, they'll have a clear understanding of what their range will be, and they'll state that. They'll say, look, we are a B2B SaaS business, we're seed or pre-seed, we've got X amount of traction, we've looked at other companies in our space, we've benchmarked that against different sources. We'll have had chats with some friendly investors that we know about, and then they go out and they blitz every investor that they know with that process, starting from the investors that they probably don't really want at the start, to kind of get the pitch, get the FAQ, test the valuation there and get that kind of market feedback, and then just be kind of gauging that as they go through. So yeah, definitely no silver bullet, but research and talking to people, and like using networks. I'm sure like there's plenty of people that you can benchmark and soundboard.
Networks like Entrepreneurs Collective. Yes, exactly.
That was my plug, Mike. I was doing it for you.
Oh, boy.
But yeah, no, like it is like it's one of the advantages that certainly founders have now that we've seen over the last 5 years, is that there are these fantastic networks out there. There are these fantastic platforms out there. There's just so much more data about companies and raising. So,
and I think one of the things that we like to do is we will like review your deck, or one of the team will review your deck, give you some feedback, and then what we do, what we think before you sort of start spending too much time fundraising at the wrong valuation, we always say try and find 2 or 3 investors who aren't really investors for your sector, but who will look at this as a sort of independent prospect, and just send it to them very much in saying, look, can you just give me some brutally honest feedback? Tell me what you think about the proposition. Tell me what you think about the valuation. Because to be honest, you want to get that. It's a lot better to get that feedback really early on. The worst thing I see is when founders, they either get the valuation completely off mark, or there's something like a big hole in their deck, but because they don't ask for feedback, or sometimes it's the opposite, like sometimes they're really, really nice and the investors just don't want to give the feedback, or they don't engage, and they spend 2 months and 20-30 meetings trying to sell a company with something that frankly really needs to be fixed. So it's a lot better to try and get some honest feedback right at the start. Okay, so we'll hopefully that helps, and we're going to move you onto.
I do have a couple of questions before you move on to the next question. I think this one's short. So do you mind if I ask you what's the percentage of the deal maker's fees on term sheets typically? The percentage, let's say, if going back to your example of the fintech being valued 10 to 12 times the sales, let's say, then like what would be the percentage on the deal makers' fees? And Bill, as a lawyer, do you also get involved in the pitching process, or do you outsource the work?
In terms of pitching to investors?
Yes.
No, to be honest, you know, I think actually having a lawyer in the room can be quite incendiary. And actually a lot of time when we're, you know, doing the term sheet negotiation, you know, we'll actually stay in the background so that, you know, the founders are, you know, front and center. You guys are well armed with the points that you need to go in and negotiate on and understand fully what, you know, what's going back and forth. Because, you know, as soon as when you're negotiating principal to principal, it can be very, you know, it can be efficient, it can be quick. As soon as you got principal to principal plus legal teams, it can slow things down. So I always say, look, let's keep in the background for as long as possible. Then once the term sheet's fully negotiated, we've got all those points, we can come in there and execute alongside you. So we'll be there the whole time, but you know, typically you kind of try to stay in the background.
Yeah. And I think if you're talking, when you mentioned deal makers, are you talking about, I guess, professional fundraisers who would help you raise the funding?
Yes, raise their funding and sell the company potentially.
Yeah, so it really depends on the amount of your fundraising. Typical is probably 6% below about 500,000, 5% from 500,000 up to about 8 or 10 million, dropping down to 2 or 3% to 10 to 20 million. So it's fairly standard. Obviously, if you use like a Crowdcube or a Seeders, and you know, if you're in a bad negotiating position and you really need help, then sometimes there can be, the fees can go up to as high as 7, 8, or 10%. And some fundraisers will not work without an upfront fee. Mainly, and you know, I think there's two ways of looking at it. And sometimes I think it's fair enough, which is, if you have no investment from the founder's side into the process, it's very easy to go out and contact 5, 10 different people. You can go off as a fundraiser, spend you know, 2 months trying to do the fundraise, and then he says, oh well, actually no, I don't want to fundraise right now, or I've changed my mind, or I've got a better valuation elsewhere. And I think, you know, from the fundraiser's perspective, it's not just, sometimes, yes, there's sometimes unscrupulous fundraisers are just looking to extract money. So you have to be careful for that. But I think you know, sometimes it is generally that, you know, they want a client who's invested in the process and is going to work with them, and not just, you know, play the game as well from their side. So yeah. Okay, hopefully does that answer your questions?
Yes, it did. Thank you.
Okay, great stuff. Okay, so right. Okay, Tom O'Neill. Hi, Tom.
Just a quick question. I am probably in a position where I'm almost about to give out more or grant more options than my share option pool has. I can kick the can down the road, but I'm just wondering, if I have a conversation with investors and shareholders, etc., is it the expectation for all shareholders in existence, including founders and investors, to take that dilution, or would they kick back and say, no, Tom, you, as a founder, you take it? Or is it split 50-50? You know, what kind of scenarios are there? Thanks.
No worries, well, I would say, you know, what are your investors like?
Reasonable, hopefully.
Okay, well, look, if they're reasonable, I'd expect the dilution to be spread across everyone. And, you know, like the rationale stacks up when we do that, because effectively what we're saying is, look, we're going to take this equity, we're going to give it to employees who are going to be highly incentivized, highly motivated to grow the business and get us to an exit. And ultimately, you know, all shareholders will share in that success and that in those profits. So, you know, it's only right that should be spread evenly across, would be what I'd go and tell them, Tom.
And is that presumably, is that a shareholder vote right? As in, so if I get 90% of investors and shareholders to sign up to
it should be, it would be detailed in your investment agreement or your shareholders agreement. If you take a look in there, it's more than likely an investor majority consent matter. So you may have to, go out and get consent from the investors, just with a circular to an investor, to the investor majority. But I'd tee that conversation up first with the kind of main investors and just say, look, here's the position of the documentation. We need an investor majority consent here, across the whole shareholder base. I wouldn't even kind of taking the dilution yourself, to be honest. I'd just say, look, we need to increase the option pool. Here's the fantastic team that we're building and are going to be working with. Let's up the option pool and just.
Okay. Awesome. Thanks, guys.
No worries at all.
Okay, great stuff. Well, I think that's the majority of the questions, and I know we're 20 minutes over our allotted time, so I think we'll call it at that point. Once again, thank you for everyone for attending. Bill, for a hugely insightful presentation and some great questions. As I mentioned, please do feel free to reach out to Bill if you want to pick his brains or if we missed your questions. Do take him up on his offer for a free consultation when the time is right. From myself, I will bid you thank you all for coming, and good night.
Thanks again, Mike. Thanks, everyone.
Thanks, Bill.